Hello and welcome. In the previous chapter, we discussed how expected credit loss, or ECL, is calculated using probability of default, loss given default, and exposure at default. In this chapter, we will discuss one of the most important foundations of IFRS 9 implementation, data governance, and model development. This chapter is very important because IFRS 9 does not depend only on accounting entries. It depends heavily on the quality of data, the reliability of models, and the strength of internal controls. A bank may have a sophisticated ECL model, but if the underlying data is incomplete or inaccurate, the final ECL result will also be unreliable. So, the first message of this chapter is simple. Good ECL calculation starts with good data. Under IFRS 9, banks and financial institutions are required to estimate expected credit losses using historical information, current conditions, and forward-looking information. This means that banks need data from different areas, including customer information, loan information, repayment behavior, default history, collateral details, recovery experience, and macroeconomic indicators. Let us start with borrower data. Borrower data helps the bank understand the risk profile of each customer. This may include the borrower's name, customer 499, borrower type, business sector, location, group relationship, related party status, internal credit rating, external rating if available, financial statements, cash flow position, and repayment capacity. For corporate and SME borrowers, this information must be updated regularly. If the bank uses old financial statements or outdated business information, the credit risk assessment may become incorrect. The next important area is facility and loan data. This includes the loan account number, facility type, sanction amount, disbursement date, maturity date, outstanding balance, interest rate, repayment schedule, installment amount, security details, undrawn limit, and rescheduling or restructuring history. This data is very important for calculating exposure at default, or EAD. For a normal term loan, EAD may be close to the outstanding balance, but for overdrafts, credit cards, and revolving working capital facilities, EAD may be higher because the borrower may use additional limits before default. The third category is repayment and delinquency data. Repayment behavior is one of the strongest indicators of credit risk. Banks should maintain accurate information about due dates, actual payment dates, overdue amounts, days past due, missed installments, partial payments, check return history, excess over limit, and overall account conduct. Days past due is especially important for staging. For example, if a borrower is regularly paying on time, the loan may remain in Stage 1. But if repayment delays continue, or if the loan becomes more than 30 days past due, it may indicate a significant increase in credit risk and may require movement to Stage 2. The fourth category is default and recovery data. This data is necessary for developing probability of default and loss given default models. Banks should maintain information about date of default, reason for default, non-performing loan status, classification status, recovery amount, recovery date, collateral realization, legal recovery cost, write-off amount, settlement amount, and time taken for recovery. Historical default data helps the bank estimate how often borrowers default. Historical recovery data helps the bank estimate how much loss may arise after default. In Bangladesh, recovery may be affected by legal delays, collateral enforceability, borrower cooperation, and market conditions. These realities should be reflected in LGD assumptions. The fifth important area is collateral data. Collateral plays a major role in estimating loss given default. Banks should maintain information about collateral type, ownership, legal documentation, market value, forced sale value, valuation date, insurance status, prior charge, enforceability, expected recovery time, and expected recovery cost. It is not enough to simply say that the bank has collateral. The bank must assess whether the collateral is legally enforceable, whether the valuation is updated, whether there are any disputes, and whether the collateral can actually be realized within a reasonable time. For example, a property may have a high market value, but if legal documents are weak or ownership is disputed, the actual recovery may be much lower. Now let us move to macroeconomic and forward-looking data. IFRS 9 requires banks to consider not only past experience, but also future economic conditions. Relevant macroeconomic information may include GDP growth, inflation, interest rate, exchange rate, unemployment, export growth, import trends, remittance flow, commodity prices, and industry performance. For Bangladesh, banks should also consider sector-specific risks. For example, export-oriented borrowers may be affected by global demand and exchange rate movements. Import-based businesses may be affected by foreign currency shortages or higher import costs. Real estate and construction borrowers may be affected by interest rates, property prices, and liquidity conditions. Agricultural borrowers may be affected by weather, commodity prices, and government policy. Therefore, forward-looking information must be reasonable, supportable, and properly documented. Now let us discuss data governance. Data governance means the system of policies, responsibilities, controls, and procedures used to manage data. A strong data governance framework ensures that data is complete, accurate, consistent, timely, reliable, traceable, and protected from unauthorized changes. In practice, this means each department must know its responsibility. The credit department may be responsible for borrower and facility data. The risk department may be responsible for credit ratings, PD, LGD, ELD, and staging methodology. The finance department may be responsible for accounting, reporting, and reconciliation. The IT department may be responsible for system extraction, data security, and access control. Internal audit may review whether the controls are properly designed and operating effectively. Without clear data ownership, errors may remain unresolved, and the ECL result may become difficult to defend before auditors or regulators. Before using data for ECL calculation, banks should perform a data quality assessment. There are 6 important areas to consider. First, completeness. All required data fields should be available. For example, if the maturity date is missing, the bank cannot properly determine the remaining life of the loan. Second, accuracy. Data should match the source documents and core banking system. For example, the outstanding balance used in the ECL model should agree with the general ledger and core banking records. Third, consistency. Definitions should be consistent across departments. The meaning of default, overdue, rescheduled loan, and non-performing loan should not differ between credit, risk, finance, and reporting teams. Fourth, timeliness. Data should be updated within a reasonable period. For example, Collateral valuation from many years ago may not be reliable for current ECL calculation. Fifth, validity. Data should follow approved formats and logical rules. For example, a loan maturity date should not be earlier than its disbursement date. Sixth, traceability. The bank should be able to trace data from the source system to the final ECL report. This is very important for audit trail and regulatory review. Now let us discuss model development under IFRS 9. Model development means creating a structured methodology for calculating ECL. The main models include the PD model, LGD model, EAD model, staging model, forward-looking model, and scenario weighting model. Let us start with the PD model. Probability of default measures the likelihood that a borrower will default within a certain period. For Stage 1, banks use 12-month PD. For Stage 2 and Stage 3, banks use lifetime PD. PD may be developed using historical default rates, internal credit ratings, rating transition matrices, scorecards, statistical models, or expert judgment. For example, if historical data shows that 3 out of every 100 similar borrowers default within 1 year, the 12-month PD may be around 3%, subject to adjustment for current and future conditions. The PD model should consider borrower-specific factors such as repayment history, financial performance, cash flow, leverage, profitability, industry risk, and management quality. It should also consider economic factors such as GDP growth, inflation, interest rate, and exchange rate. Next is the LGD model. Loss given default estimates the percentage of exposure that the bank expects to lose if default occurs. LGD depends on collateral coverage, collateral type, legal enforceability, recovery experience, recovery cost, time required for recovery, seniority of claim, and economic condition. For example, a fully secured loan with strong and enforceable collateral may have lower LGD. An unsecured credit card portfolio may have higher LGD because recovery after default is usually lower. Banks should not assume that collateral value equals recovery value. They should consider forced sale discount, legal cost, delay in recovery, and uncertainty of realization. Next is the EAD model. Exposure at default estimates the amount outstanding when default occurs. For a term loan, EAD may be based on the current outstanding balance and expected repayments. But for revolving products, such as credit cards, overdrafts, cash credit facilities, and working capital lines, EAD may include future drawings before default. For example, if a borrower has an unused limit of BDT 10 million and the bank expects 40% of that limit to be used before default, an additional BDT 4 million may be included in EAD. And let us discuss the staging model. The staging model determines whether a loan is in Stage 1, Stage 2, or Stage 3. Stage 1 includes performing assets, where credit risk has not increased significantly. Stage 2 includes assets, where credit risk has increased significantly, but the asset is not yet credit impaired. Stage 3 includes credit impaired or defaulted assets. Common staging indicators include days past due, internal rating downgrade, restructuring due to financial difficulty, poor financial performance, watchlist status, non-performing classification, legal action, bankruptcy, or liquidation. A strong staging model is very important because stage movement directly affects the amount of provision. Movement from Stage 1 to Stage 2 means the bank moves from 12-month ECL to lifetime ECL. CL, which may significantly increase impairment allowance. Now let us discuss the forward-looking model. A forward-looking model links macroeconomic conditions with credit risk. For example, if inflation rises, borrowers may face higher operating costs. If interest rates increase, debt servicing burden may become higher. If export demand decreases, export-oriented borrowers may face reduced cash flow. The bank should identify which economic variables are relevant for each portfolio. For example, SME trading may be affected by inflation, import costs, and exchange rates. Housing loans may be affected by interest rates and property values. Agricultural loans may be affected by weather, commodity prices, and government policy. Where historical evidence is available, the relationship should be supported by data analysis. Where historical evidence is limited, expert judgment may be used, but it must be clearly documented. And now comes scenario weighting. Since the future is uncertain, banks should not rely on only one forecast. Normally, banks develop a base case, an optimistic case, and a pessimistic case. Each scenario is assigned a probability weight. For example, the base case may be weighted at 60%, the optimistic case at 20%, and the pessimistic case at 20%. The final ECL is calculated as a probability-weighted outcome. Scenario weights should be approved by management and reviewed regularly. Another important area is model validation. A model should not be used blindly. Banks must check whether the model is reasonable, reliable, and fit for purpose. Model validation may include backtesting, sensitivity analysis, benchmarking, review of assumptions, data quality testing, and independent review. Backtesting compares previous model estimates with actual outcomes. Sensitivity analysis checks how ECL changes when assumptions change. For example, management may check how the ECL amount changes if PD increases by 1% or LGD increases by 5%. Model validation should ideally be performed by a team independent from the model development team. Now let us discuss management overlay. Even a good model may not capture every risk. Sometimes management may identify additional risks that are not fully reflected in the model output. Examples include sudden sector downturn, natural disaster, regulatory change, sharp currency movement, political uncertainty, or model limitation. In such cases, management may apply an additional adjustment known as management overlay. However, this adjustment must not be arbitrary. It should be evidence-based, properly documented, approved by appropriate authority, and reviewed regularly. Documentation is another critical requirement. Banks should maintain proper documentation for all data and model-related decisions. This includes data dictionary, data source mapping, data quality assessment, model methodology, PD, LGD and EADD assumptions, default definition, staging criteria, macroeconomic assumptions, scenario weights, management overlays, approval records, validation reports, and audit trail. Good documentation helps management, auditors, regulators, and internal reviewers understand how the final ECL number was produced. Now let us briefly discuss the role of internal audit and external audit. Internal audit should independently review the ECL framework. It may assess data governance, data accuracy, access controls, model development, model validation, staging accuracy, management overlay approval, and reporting controls. External auditors will evaluate whether the ECL provision is reasonable and compliant with BFRS 9. They may test the completeness and accuracy of data, reasonableness of PD, LGD, and EAD, staging criteria, macroeconomic assumptions, scenario weighting, collateral valuation, management overlays, and disclosures in the financial statements. Finally, let us consider Bangladesh-specific issues. Banks and financial institutions in Bangladesh may face challenges such as limited long-term historical default data, frequent rescheduling and restructuring, sector concentration risk, recovery delays through legal process, collateral valuation uncertainty, manual data processing, and coordination, gaps among credit, risk, finance, and IT departments. Therefore, IFRS 9 implementation in Bangladesh should be practical, phased, and supported by strong governance. Banks should improve data quality, strengthen systems, train staff, document assumptions, and ensure regular review by senior management. To summarize, data is the foundation of IFRS 9 implementation. Reliable ECL calculation requires borrower data, loan data, repayment data, default data, recovery data, collateral data, and macroeconomic data. Data governance ensures that information is complete, accurate, consistent, timely, and traceable. Model development covers PD, LGD, EAD, staging, forward-looking adjustment, and scenario weighting. Model validation, documentation, and governance are essential for audit readiness and regulatory confidence. For banks and financial institutions in Bangladesh, successful IFRS 9 implementation will depend not only on technical modeling, but also on strong data discipline, cross-functional coordination, and continuous monitoring. In the next chapter, we will discuss governance, internal control, audit readiness, and regulatory reporting under IFRS 9.